Hello and welcome to this course, Advanced Business Valuation. Why is it called Advanced? It's called Advanced because it touches upon all the technical valuation nuances that were not covered initially in your basic corporate finance class. For those of you who are joining us from minor courses or from School of Economics or from other departments, or for those of you who have taken the Financial Statement Analysis Introductory course and the Advanced Business Analysis and Valuation Introductory course, these concepts will be a little bit new to you. My idea is to introduce these concepts at this time and to draw your attention to reflect upon them carefully and to see how they are likely to impact your valuation. How does that impact your valuation? I will show you in a minute how different accounting measures and the way that they are measured or the way that they are accounted for is reflected in your valuation model. So for today, my idea is to have a broad overview of a large number of accounting transactions that are likely to impact your valuation model. Of course, the list is not exhaustive, but I believe that the time allocated for this course would allow me to cover most of these in your valuation course. I would start basically by introducing you to some kind of accounting measures that would impact your valuation. We have already discussed that a basic valuation methodology involving any number of discounting procedure requires two or three components. The first component is that the value of a firm, whether viewed individually as an equity or together as an enterprise, whether talking about it as equity holders alone owns the stock or debt holders also own the stock put together, that's the enterprise angle. There are 3 or 4 components involved. The first component is always what you are discounting. What are you going to discount in this course? You could be discounting cash flows. You could be discounting dividends. You could be discounting earnings or residual income. You could be discounting economic value added. And that means your numerator is very important in this equation. After you've decided on what you are going to discount in your numerator, dividend, earnings, cash flows, whether enterprise cash flows or equity cash flows, economic value added or adjusted present values. Once you are decided on that, the next thing to decide upon is what discount rate am I going to use to discount my cash flows or my earnings or my dividends or my economic value added. That is the second component. The third component is the time horizon. How many years am I going to discount? Am I going to discount for 1 year, 2 years, 3 years, or 4 or 5 years? You need to decide upon the timing. And last but not the least, we've discovered that firms don't exist just for a few years and disappear. When companies are set up, the entire idea is that these companies would continue to exist into the foreseeable future. And therefore, you have a notion that the part of the value of the company into the foreseeable future that you do not know yet, you need to make a reasonable estimate for. And that reasonable estimate would require some input valuation. We have already discussed the formula. If you are not familiar with the terminal value formula, I encourage you to review the previous lecture slides and familiarize yourself with how to calculate a terminal value. For this course, I will be talking to you about how earnings are measured and how these measurements or differences in measurements can affect your earnings, your dividend, economic value added, or your free cash flows. These differences in measurement can be due to accounting standard differences. For example, differences between US GAAP and IFRS. For example, differences between IFRS and local accounting GAAP. If you are valuing a Chinese company, how will differences in accounting standards impact your value? If you are valuing a Japanese company, how will differences in accounting measurements impact your cash flows or your numerator? What variables affect earnings? For example, in some other parts of the world, reserves are allowed, and use of reserves would affect the way that earnings are accounted for. How do you account for differences in these measurements? Are you valuing the firm because it is reporting under IFRS, but also has a significant US exposure or US subsidiary? Or are you valuing the firm on the consolidated level? Are you valuing the parent company or you are valuing the subsidiary? Are you valuing the consolidated financial statement reported or you are valuing only the standalone parent reporting? All of these would affect your numerator. Of course, that is not the only thing that impacts your valuation model. How about the denominator, which is your cost of debt or your cost of equity or both of them put together? That is your weighted average cost of capital. How do you measure your cost of equity and your cost of debt? What is the effect of capital structure? Is it a stable capital structure or is it a moving capital structure? Is it a constant capital structure or it's a constantly moving capital structure? What is the effect of taxation on your cost of debt? When a company is exposed to changes in tax rates across jurisdictions, what effect will that have on your discount rate? Does a higher tax rate lead to much benefit on your cost of debt, or does a lower tax rate benefit affect your company negatively because you will have a low interest deductibility? What accounting variables affect the discount rate? For example, if you want to take on more debt, you need to show healthy cash flows. And healthy cash flows will translate into a lower cost of debt because companies will view you as being able to operate and generate free cash flows to service your debt. And therefore, your discount rate will be affected differently. Now that I have introduced you to the concept, I would like to spend time and mention some of these accounting variables. These accounting variables, like I pointed out earlier, are not exclusively for one valuation method or the other, or they are not exclusive to one valuation model. They are things that you should know and be aware of as analysts. If you do spot them in the notes to the financial statement or to the conference calls or to any number of pieces of information that the firm has provided, you should be able to make an adjustment to your financial statement and therefore have it flown into your valuation model. So the first I would like to talk to you about in terms of accounting is revenue recognition. As you may be aware by now, revenue line is the first line item you come across on the face of the statement of comprehensive income. This number is so important that any number of changes in accounting standard would affect this number. If a company doesn't report the revenue number correctly, that means your sales forecast would be wrong and therefore will affect your cash flows statement or your free cash flow modeling. You would always have to calculate revenue growth and be able to forecast the sales of the company going forward. Of course, I acknowledge that differences in accounting standard will affect this variable. If you use US GAAP reporters have a different accounting standard that governs sales. If you use IFRS rules are different from US GAAP in terms of how they affect sales accounting. And that same goes for several other accounting standards across the world. But in this course, I will focus mainly on IFRS. I will talk about IFRS 15, which is the accounting standard that governs the sales number. Of course, I will not be able to cover all of it in one lecture. So my idea is that I will have a gentle introduction throughout this introductory video, and then in the future videos I will make shorter videos on each accounting transaction that has a significant effect on your valuation model. You will then have the chance to review them and use them independently to make adjustment as and when necessary to your valuation model. The second is stock options and share-based payment. What are stock options? I will talk about it in a separate video and tell you why stock options are important and how they can impact your valuation model. But shortly, stock options are a compensatory method used by companies where they give executives, but also high income earning people within the company who has an impact on the business, not to give them cash as compensation, but to align their interest with that of the company. They are given options, and that if some milestones or some rules are met, these stock options can turn into shares of the company, and therefore to be termed as share-based payment. They have an impact on valuation. I will talk about it in a separate video. Taxation and deferred taxes, tax rates, they are very, very important. Why are tax rates important? Tax rates are important because for 2 or 3 reasons. One is the fact that interest deductibility on cost of debt is important, and therefore a very good tax number or a high tax rate will reflect the fact that the company would get a much benefit on the amount of cost of debt they are currently using to value their company. But of course, it does not make sense that you only set up a company to benefit from the higher taxes. High taxes could also mean that the company is unable to project and grow with cash flows. So a fair balance between high and low tax rates are important. And of course, when you sell and buy assets and liabilities, it might give rise to deferred tax assets and deferred tax liabilities. Are deferred tax assets actual assets that must be included in your valuation? Are deferred liabilities real liabilities? We will talk about that. And most importantly, and the third one, is tax rates. What tax rate do you use in your valuation model? Do you use the effective tax rate? Or do you use the statutory tax rate, or which is otherwise called marginal tax rate? Or do you simply go for a cash tax rate? And which part of the financial statement would you use to extract this kind of information? A separate video on taxes will be uploaded later. I will talk about pension obligations. What are pension obligations? Pension obligations simply refer to the fact that when companies hire people, they promise them a certain amount of pension. That when you leave the company after working for several years, you will get compensated in the future. One way of seeing it is like you get a pension, and that pension is either managed by the company or given to a pension fund manager who manages it. This will give rise to 2 types of pension accounting. One is defined contribution, and the other defined benefit scheme. One of them would lead to a large amount of asset or liability on the balance sheet, and the other would just lead to a mere expense that goes through the income statement. How that impacts valuation will be discussed in the future video. Accounting for provisions. Very briefly, what are provisions? Provisions are any number of events that have occurred within the company that has led to a potential liability that will occur in the future. And therefore, this liability that will occur in the future have to be provided for. The company basically puts aside some money, waiting for the future occurrence of that event so that they can use that money to pay for the event. Example include decommissioning cost. When you start an asset such as an oil rig, you know that you will have to break down the oil rig when you have finished extracting the oil. You know that you will break it down in 20 years' time, and the useful life of the well is 20 years. And the cost that will be incurred in 20 years to dismantle this asset or this oil rig will be significant. So what do? You create a provision on the balance sheet. Every year you make sales or you make profit, you put some aside, hoping that that would be sufficient to cover the cost of decommissioning that oil rig in future. There, it can impact your valuation significantly if this is not properly measured. I will cover that in a separate video as well. Leases, accounting for leases. By now, the accounting students, as well as some of the finance students in the previous course, Business Analysis and Valuation, would have come across leases as an adjustment. Lease accounting is very important, especially for companies that heavily use leases for their business model. Think about airlines as an example. Airlines lease or rent planes to fly people around. They are not actually the asset of the company, they are basically leasing it. But that implies that the size of their balance sheet will not be the same if they were to acquire them outright by paying cash for them. We will discuss the effect of leases and how that impacts the balance sheet. Does lease accounting have a positive effect on the cash flows, or it does not have a positive effect on the cash flows and therefore your valuation model? We will cover that in this course. And of course, there are some other things such as derivatives and hedges. What are derivatives or hedges? These fall under the risk management component and the risk exposure that firms have on their earnings or cash flows. Take, for example, you are a US dollar company, but you sell most of your goods to British pounds customers. That means your customers can either pay you in British pounds or they can pay you in US dollar. That means that your sales or your earnings is exposed to the exchange rate differences between the pound and the US dollar. The strengthening of the pound against the US dollar or the weakening of the US dollar against the British pound can have a material effect on your cash flows. In this course, my idea is to introduce you to the role of risk management and what strategies firms go through to minimize the effect of these risks exposures on their financial statement. Some of those other things we will cover in terms of risk management or derivatives are when companies issue debt in foreign currencies. They go to the US and issue Eurobonds, and these Eurobonds are denominated in another currency. A change in the exchange rate in these currencies can have a material effect on their cost of debt. I will discuss with you how that will flow back into your valuation model and to what extent that can impact your cost of debt and your discount rate. Fixed asset revaluation and changes in depreciation policy. By now, you are fully aware of what depreciation means and how companies account for depreciation. Literally, there are about three main methods of depreciation. The first one is straight line depreciation. The second one is the reducing balance method. And the third one is the unit of production method. All these three methods are covered under IFRS, and companies are allowed to choose whichever one reflects their business model. However, sometimes firms use them interchangeably or change from one to the other depending on how advantageous that will be for them in terms of earnings. I will discuss with you in a separate video how differences in revaluation and depreciation policies will impact your cash flows at the end of the day, and to what extent that when you are valuing a company next to its competitor, if one of them is using a straight line depreciation method and the other one is using a unit of production or a diminishing balance method, how would you be able to make adjustments to your earnings forecast to make sure that both companies are comparable in nature? Biological assets remeasurements and fair value accounting. Biological assets, by their name, make no mistake, these are not lethal weapons. These are not ballistic missiles that are going to be sent. No, that's not what I'm talking about. Biological assets refers to anything that is related to agriculture that will grow, that you will put on the ground or you will take care of it to grow from beginning to an end. Examples include livestock, like a cow, if you remember the cow valuation exercise in class, like timber, like oil palm plantation, coconut, vineyards, grapes, milk, and so on and so forth. How do you account for these? Especially if you remember my example about if you buy a plant of timber for €5, you plant it today and you want to measure how much profit you've made after 2 years, you can't, because it's not yet ready to be sold. You have to wait for 20 years until you sell it to make a profit. But in between that, you need to measure the changes of the growth, and that changes in fair value can be determined as profit. I will talk to you about how companies that are heavily exposed to biological assets in their reporting report these changes, and how to make cash flow adjustment because they are non-cash items. investment property remeasurement and earnings. There are several accounting standards across the world that cover the way that investment properties are reported. But largely, companies in the real estate sector have their own accounting standard that they have to use. For example, hotels, when they buy property to use as rentals or to use in the hotel business, they have to measure them separately. If you are a company and you are basically in the real estate real estate industry where you basically buy and sell property, there are differences in the way you measure them. If you are a company that basically is in the leasing business, you buy a property to lease, there are different ways to measure them. And these remeasurements go through your earnings. And therefore, although they may not be cash driven, they could have a material impact on your cash flow estimation and your free cash flows. We will discuss that in detail. Discontinued operations, joint ventures, and joint operations. Discontinued operation is just basically a subsidiary, or what we call a CGU. A CGU is a cash generating unit, a separate asset of your business that can generate independent cash flows by itself. If you are no longer interested in keeping it as part of your portfolio of assets that will produce cash flows and earnings in your business, you will have to designate it separately that you are willing to sell it. And therefore, at the reporting date, you don't longer count it as part of your normal operations. You put it aside. I will talk about how to account for that in your valuation model. Do you treat it as normal part of your operation in estimating your cash flow forecast, or you forecast a cash flow separately for this unit? How about joint ventures? You co-own companies or assets with other competitors. Take, for example, if an oil company or two oil companies like Shell and BP both have a pipeline that runs from Russia into Europe. The two companies both have access to the pipeline. They both contributed in certain proportions to build up this pipeline. How do you account for it in your valuation model? Do you separate them when you value, or do you use a proportionate method, or how do you account for that in your cash flow forecast? How about joint operations, companies that jointly own an asset that is meant just to operate? For example, 2 or 3 firms have an airport. How do you report the profit from the airport in the cash flow forecast that you're going to make? Do you report it on a proportionate basis? Do you report it using an equity accounting method? Or do you simply just ignore it that it's not significant? We will discuss that in more detail in this course. Then comes foreign currency, commodity prices, and interest rate changes, and how that will impact your valuation. I have alluded to the risk of foreign current exchanges. When you do businesses across the world, you are exposed to exchange rate changes, either in using the spot rate or using the forward rate or using a reporting currency system like a centralized exchange rate system. How does that reflect on your currency situation? How do you forecast earnings knowing that the earnings that are coming from a subsidiary located in a country such as Venezuela or Turkey or Russia are heavily exposed to exchange rate depreciation or hyperinflationary environment? Do you simply ignore the effect of foreign currency changes, or you just say it doesn't matter? We will discuss commodity price changes for companies such as airlines that are exposed to oil price volatility. How do you forecast their sales? How do you forecast their cost? How do you forecast, therefore, their profits and cash flows, knowing very well that oil prices would very much determine how much cash flows they are going to make? How do you incorporate that into your valuation model? Do you simply assume that it will not have a material impact? Or do you simply assume that a rise in oil prices would diminish demand? Or the other way around, a decline in oil prices would lower the cost of airlines and therefore would spike up demand? We will discuss that in this course. And of course, interest rate changes. Companies issue debt in several different currencies and several different interest rates, either on the fixed rate of interest. When they take a loan at a fixed interest rate, it might have a material impact if interest rates decide to fall. How about if they don't take fixed interest rates and interest rates go up? What material impact would that have on the interest cost that they pay? And how would you include that in your valuation model when you forecast interest expenses? Will that have a material impact, or will that not have a material impact on your earnings forecast? And of course, companies are in the business of buying shares back. They buy their own shares from owners for several reasons. One is that they want to increase the equity value in the market. They want to limit dilution. They want fewer people to own the stock, therefore driving up prices. But what is the overall effect on your valuation model? When companies buy back their own shares, that means the number of shares in circulation are now fewer than before. The company had 100 million shares. This year they bought back, let's say 40 million. It means only 60 million of their shares are in circulation. How will that affect your equity valuation? How would you adjust that in your equity valuation model? How about transactions with owners that doesn't include cash flows? For example, if the company does a stock split or a right issue or any number of share donations, will that affect your valuation or not? I want you to be able to take away from this course some of these nuances that will help you in your future career. Of course, that's not the only accounting nuances that you need to be aware of. You need to be aware of what we call restructuring charges. Every now and then, companies are in the habit of restructuring their companies, whether they are not performing well or they want to reposition themselves or close down a non-profit making subsidiary and open new branches and do all sorts of things. These typically come with cost. These restructuring costs can lead to job losses. A lot of employees would have to be let go. They have to be paid. It can lead to the sale of some assets. It can lead to the breakdown of some subsidiaries or some assets. How do you account for that in your earnings? Because it's an expense. How do you account for this expense? How do you forecast this expense? And what is the overall impact on your valuation model? One-time impairment charges. By now you are aware of the word impairment. What is an impairment? An impairment is basically that the value of an asset in use has diminished. To put it plainly, the market value of a company or of a market value of an asset when compared to its value in use are no longer the same, and that results in an impairment charge. And this impairment charge can be a one-time event, but it can also be a recurring event. Do you forecast it as part of your cash flow transactions? Do you include it in your forecast, or you don't include it in your forecast? If you do cash flow analysis, you will already notice that impairment charges are non-cash in nature, and they can always have a material effect on your cash flow. How do you deal with that? Litigation cost. Just a few years ago, if you recall, there was an emission scandal by the car manufacturer VW, and VW went into litigation troubles that investors, especially the Norwegian sovereign oil fund, decided to take them to court for misleading them as an investor. These litigation costs can be quite significant because you have to pay a bunch of lawyers to go to court to defend you, but also prepare yourself that in case you do lose the case, you will have to settle. You will have to pay a lot of people who are involved. The same is the case of a company, a fertilizer company called Monsanto. If you recall Monsanto case, many people claim that the fertilizer that was made or chemical that was made by Monsanto gave them some kind of a sickness, and therefore Monsanto went to court to prove that actually it was not the case. If they lose, they would have to pay litigation costs. If they win, they will not have to pay. They would have to make some provisions on the financial statement in case they do lose. These litigation costs can be a one-time event, but it could also be an ongoing event, and therefore you need to forecast it. How do you account for it in your valuation model? We will discuss that. Environmental decommissioning and dismantling provisions. I have mentioned that a little bit earlier, but environmental provisions, for example, are cleanup costs. If you remember the spill up of oil in the Gulf of Mexico by BP, they needed to clean up. The spill up of oil by Shell in Nigeria resulted in a cleanup campaign that they needed to pay for all of these costs. How do you account for them in your valuation model? capitalization of some expenses in terms of research and development cost, especially in accounting standard jurisdictions that does not allow you to expense that. You will have to capitalize them. How do you forecast research and development cost? How do you account for that in your earnings, and therefore how do you account for them in your cash flows, your free cash flow estimation? We will discuss that in this course. Capitalization of borrowing cost. Sometimes when firms borrow money to finance an asset, to finance a certain expansion, they are qualified to be capitalized in the financial statement. They are not expensed immediately. Borrowing costs have some rules that need to be met, and that should help you in the estimation of your cost of debt. We will discuss that. How do you treat brands and intangibles in valuation? Of course, we all know that measuring the brand value of a company is a very daunting and difficult exercise. It's difficult because companies' brand or intangibles is a very, I would call it, not an objective measure of how much these are worth, and therefore it's always difficult to put a number on it in terms of when you amortize it or when you don't amortize it or when you review it for impairment. We will talk about the value of brands in your valuation. Do you include brand as an asset, or do you basically say it's an intangible? I can't measure it, I can't touch it, I can't feel it, and therefore it does not have any value in valuation. We will discuss that in this course. Now that I've mentioned significant number of accounting adjustments, I would like to point out that not all your firms will have these accounting, or will be confronted with all of these accounting nuances. Some firms would have it, other firms would not have it. But the key to success in valuation is that you are fully aware of these accounting transactions, that you can spot them and use them to make judgments that will lead to a very good valuation model. My idea is that from now on, I will pick on any one of these topics and make another video where you can always refer to and use that to perform your valuation exercise in case that is not in class. Until I start uploading these videos and until I see you in class where we discuss them in detail, it's been a pleasure, and this is Solomon Zori. If you need more, or if you want to contact me, please use the details on screen. Until next time, bye-bye from me.